This episode is sponsored by our friends at YCharts. Thousands of financial advisors, asset managers, and investors rely on YCharts to develop insights, make smarter investment decisions, and effectively communicate with prospects and clients. With industry-leading tools, you're empowered to create compelling visuals that emphasize the strengths of your investment strategies. For more information, start a free trial at ycharts.com or follow on Twitter at YCharts. Now, we hope you enjoy this episode of the 7 Investing Podcast.
Okay, good morning, everybody. Welcome to April Fool's Day. No fooling. It's the 1st of April. We're here for our April student office hours. Something I always enjoy every month. We at 7 Investing, we're making stock picks, and we release those on the first of the month. We'll chat about that in a little bit here. But we also kind of like to talk about what's going on out in the market. You know, what does the stock market mean right now? How should investors react to things like that? And let's chat about it with students and ask about what questions you have as well. And so I'm Simon Erickson. I'm founder and CEO of Simon Erickson, founder and CEO of 7 Investing. More coffee needed. Luke Hallard, our UK-based advisor out there. But Luke, you are actually not in London right now.
That's right. Although apparently London is snowing as well, I hear. But I'm in the French Alps here to ski and snowboard for a couple of weeks. Yep.
That sounds pretty fantastic. Sam, you are not in the French Alps, I don't believe. I think you're here in Houston, Texas as well. But how are things going for you this morning?
I'm in Houston, Texas, which is not as much fun as the French Alps, but one day we'll get over there.
Fantastic. Yeah, well, great. Well, please go ahead and submit your questions if you have any for us. You know, we always like this to kind of be just an educational, chat that we have once a month. Yeah, submitting kind of questions about what's going on out there. But Luke, let me kick this off by kind of recognizing that it's a challenging time for the stock market right now. I wouldn't say that anybody thinks it's easy to go out there and make money and invest in stocks. And I even see a lot of people that are kind of afraid of investing right now. We've talked with several of our subscribers saying, gosh, I got in, I lost money in the very first week. I made my first stock pick and it went down. I've even seen some people that are saying, hey, are you guys even going to stick with it as long-term investors? Are you going to try to buy options that bet against the S&P 500? Or are you going to do swing trades where you try to get in and out as quickly as possible? Luke, what do you think about the state of the stock market right now? Is this impacting the way that you invest in any way?
I think you probably know my answer to this, Simon, but for me, like long-term is 10 plus years, maybe 20 years, right? So I don't get fazed about what happens in the short term, but I totally get what you're saying. And I think if you'd started investing in the last, I don't know, year, 2 years, you've had this real roller coaster where suddenly it looks so easy to, make money on almost anything. And now in the last 6 months, suddenly you've seen a very severe correction. This isn't what investing is normally like. It's not normally so wild, but you have to reflect on that in both ways. It's not normally as easy as it was in 2020 to make a lot of money, and you don't normally lose money so quickly as you have in the last few months. I think it's impossible to judge whether you've made a good investing decision or a bad investing decision over a time frame measured in less than a couple of years. So even if I look at the scorecard and I've got 3 recommendations on the scorecard now as of this morning, and I was looking just a few minutes ago and saying, oh, well, that's great. One of mine is up and one's down a little bit. I'm falling into that same trap of forming a judgment much too quickly. And really, I won't know if those investments have been successful for many, many years to come. And so I think if you can sort of reset your time horizon and really just look that far ahead, then you probably won't be tempted to change strategy based on the prevailing market conditions. You've got your plan, you'll stick to it, find good quality companies, invest in them, hold them for a long time. That's what works for me.
It makes a lot of sense to me too, Luke. Some of the actual comments that I've gotten or heard about recently have been, are you going to sell your growth stocks and kind of go back defensive? One thing that people have really been pushing me here in Houston, probably guilty by association, living in the energy capital of Texas, has been, companies like Exxon and Chevron. Are you going to double down on rising prices for gasoline and natural gas and energy companies in a time where this is kind of the focus for the moment, so to speak? But I think that a lot of that might be short-sighted. When you kind of look at the bigger opportunities of some of the companies that we're looking at out there, at least some of our recommendations that were put on the scorecard this month, we never want to be investors that are just investing for a few months or a year or what is kind of sexy at the time. We're trying to look at things that, you know, are 3 or 5 years out. You can just sit, you can forget about it. Yes, it can be a growth style investment. Yes, it can go up and down, might go up or down 30% this year. We don't know what's going to happen in the short term, but I certainly like the long-term opportunity. Steve Symington is joining us from Montana this morning. I know that he was avoiding a flock of turkeys earlier today driving around, but Steve, we're chatting about the stock market today. It seems like the narrative has gotten a lot more defensive than it was in 2021. Any way that you're thinking about investing in the stock market right now?
Oh man, I am just. Excuse me, I'm going to move my microphone over. I'm kind of doing what I've always done, right? I put my head down, ignore a lot of that near term volatility, and figure out whether that volatility is merited. We've seen some pretty wicked valuation contraction, a lot of pretty innovative high growth stocks, and I think this is the time when stock pickers thrive really. And it's funny because, you know, I see the headline yesterday at the market close where it's like Dow concludes worst quarter since, you know, in 2 years since March 2020. And I'm like, well, good. Like that gives us some, you know, some more ammo to beat the market from here. So I'm excited for the recommendations we release now in last month and in the coming weeks. I'm really I'm stoked for that. So I don't know, just keeping my head down and finding, you know, stocks of the businesses I love and continuing to buy them over time. You know, I try not to price anchor too hard to the highs last November and the February before last. And you look and say, oh, you know, people say, I wish I would have just sold then when everything was so high. It's like, well, it's impossible to time that stuff. And, you know, so I spend my time just adding to the stocks that I like the most month after month. And over time, the rest kind of works itself out that way. And I ignore that kind of short-term noise. So I think this will be a blip in the radar 10 years from now. I'm not worried.
Luke, are you doing the same thing? Are you adding slowly to positions that you have right now? Or how are you personally approaching this?
Yeah, I am. So I put myself in a position in November where I had about 20% cash. And it was more honestly, more by luck than judgment, because I just retired and I thought, okay, I've got a exclusively growth portfolio. I really need to be a bit more sensible and perhaps balance a little bit, build a few income stocks. So I went heavily cash, preparing to start finding some of the fantastic companies actually that you've been surfacing on your own recommendations, Simon. There's a couple on my list there. And then suddenly the market contracted and suddenly I got a job again. So, you know, that money I put aside, luckily, I now have at my disposal. So as of January, I started buying back in, and I've adopted a fairly slow dollar cost averaging approach. I'm putting 2% of my money back in every month over a 10-month period. And I'm just kind of adjusting as I go. So I will be I'll be buying two things for April. 1% is going into my stock recommendation that just announced today. I'll be buying a second position in that because I've had that for a long time myself. And I'm still deciding where the other 1% will go. But yeah, I think, you know, using dollar cost averaging, trying to, not knowing, is the market going to go up? Is the market going to go down in the short term? If I dollar cost average, then I kind of don't mind which way it goes because I'm averaging my buying price.
And just to brag about Luke a little bit here, if you too would like to have a 27% compound annual growth rate over nearly 20 years of investing like Luke has done, where you can retire early and go out into the French Alps to go skiing and then get rehired out of retirement for 7investing, do what Luke does, buy and hold great companies, dollar cost average into them. Any other ideas, Luke, about what's going on? It sounds like you slow and steady, finding companies you want to ease into and buying and holding them for long periods of time, right?
You know, and it's the first time you've mentioned that 27% number for a little while. I should probably come clean, and I haven't recalculated it, but over the last 4 months, that's probably taken a decent ding. But I'm kind of optimistic it's still in the 20s at least.
Still fit.
Yes. What else am I doing? I suppose one thing, because when I wanted to build that 20% cash back in November, you know, I didn't know a big correction was coming literally the week later, but I did look at my portfolio and I did say, well, look, I've got some stocks in my portfolio that are just more richly valued than others. I still completely believe in these companies, but they're trading at a price to sales or a price to earnings ratio that's just a little uncomfortable. And so those were the stocks I went after, even though I completely believed in the mission, and I took a little bit off of each of those to build that cash position. And so we're in this volatile period right now as I'm buying back in. I'm applying that same judgment actually. So I'm tending, if I have sort of two or three things I'm trying to decide between, I'm tending towards the thing that seems to have the more reasonable valuation, because we don't actually know where the market's going to go, well, by the end of today, let alone next week or next month. And things are so volatile at the moment. We do seem to be, perhaps we've hit the bottom and perhaps we're on the way up, but who knows? And so on the off chance that there may be significant downside still ahead of us yet before we really see the bottom, I'm trying to be a bit prudent. So I'm not buying dividend stocks just yet because I don't think that's the right thing to do for me in this market. But I am buying growth stocks that I think have more sensible valuations. So yeah, looking at financials a little bit more, perhaps being a bit more prudent with my investments right now.
That's perfect, Luke. I think it, and by the way, if anyone has any questions, please ask them in the Q&A or the chat at the bottom of the screen there. We're going to take any questions. That's the whole purpose of us doing this, is to take your questions and respond. But just to segue with what Luke just said, I think it's interesting. I'd like to add some context too about the dividend stocks. Dividends pay you normally every quarter with a cash payout, but you can actually go and buy more stocks with that automatically into your brokerage account. And in fact, this is a topic that Luke and I chatted about before he even joined 7investing. He was kind enough to have me on his own podcast for the Telescope Investing podcast. And we chatted about kind of the balance, or at least a balance that I like to have, between kind of high growth stocks that are a little bit more volatile. You're swinging for the fences a little bit more. Maybe their future cash flows are 3 or 5 years out, but they're building the capabilities. They're investing in R&D. They've got a visionary leader that sees the opportunity out there. But maybe it's okay to balance that sometimes with dividend paying stocks, especially companies that are growing those dividends over time. And I almost hate to say it, that if there's a silver lining to the market selling off, it's that a lot of times you're getting a better price on companies that are paying you dividends to buy more shares of that company and reinvest it over time. And as somebody who does this strategy personally, I'm half of my portfolio is in dividend growth, what I would consider it to be. I can rest very easy at night when the stocks are selling off and the market's selling off, because I just say, okay, I've got the plan set up. I'm reinvesting dividends. Companies that are increasing those over time might not be as exposed to a lot of that volatility as the rest of the market is. One example of this that I'll give is Tractor Supply. If anyone is familiar with this company, this is a retailer that serves kind of rural communities, right? So it's selling deer corn and chicken fencing and stuff like this. I know Steve loves this to keep the turkeys out of his yard up in Montana. But, this is a company that a lot of people would dismiss and say, oh, it's not a sexy investment. That's not something like a Tesla out there. This is a company that actually is doing fantastically well. It serves its customers very well. It's been growing its comps. But the intriguing part, too, is that as a dividend paying stock, it increased its dividends 77% year over year. And it was already paying a fantastic payout before that too. And so this is a company that's signifying to the market, hey, we've got cash available. We're comfortable with how our business is doing right now. We don't have to go out there and build 300 new stores next year. We're going to keep those cash flows coming in, and we're going to share this with you as an investor. And if you're an investor that's worried about the volatility of the market right now, or you a little unsure about what's going on with the broader market, maybe companies like those that are steady and established and are paying dividends could be great opportunities. It's one that I certainly have been a fan of for many years. Sam Bailey, I'd love to bring you into this conversation. I know that just yesterday, you were chatting with our fellow lead advisor, Dana Abramovitz, who's going to be joining our program here in a little bit, and also our analytics advisor, Ashley Wilson, about what it means to be a woman investor. Women are becoming much more involved in investing these days too. How do you think about investing? How has your approach changed in the last couple of years? Any context you'd like to share? We'd love to hear it.
Well, my approach has changed since I started working here. And we talked about this a lot yesterday about trying to encourage women to be more confident in investing. I think it can be overwhelming, especially if, like me, I came from a family where my dad made all of our financial decisions. It wasn't really something that my mom was familiar with. And I didn't know exactly what I was doing, and I was scared. So market would sell off. I would be scared about my money. In my early 20s, I would try to hedge, take advantage of, I don't know. I didn't have the confidence. Now my mindset has shifted completely. It's done a 180. If the market sells off, great. I'm going to add more. This is the time to add to my portfolio. This is how I'm going to create long-term wealth and go to the French Alps one day. that's what I want to do. So just the confident to hold on, stay the course, and if I trust the thesis of the company when it's up, and nothing's changed, continue to trust it and use that as an opportunity to add to my positions.
Sam, we're chatting with students here today, right? And I thought that one of the takeaways you had on your call yesterday, which was really insightful, was that we're busy, right? We've got a zillion things going on. Maybe if you're a student, you got to go to class, you got other things that you're focusing on right now. You might not want to spend 8 hours a day analyzing stocks. How do you address that? How do you address anybody that asks that question of, I just don't know how to get started, or I don't have the time for this, or anything like that? Anything that you'd like to say either to women investors or student investors that might be saying things like that?
I have a great service for you. It's called 7investing.com, but really, that's what I do. I don't have time to pore over these filings. I have a full-time job. I work, I have kids. I just don't have time, but I have access to 7 lead advisors here who do have time because this is what they do for a living. And I trust in your judgment. I mentioned this yesterday. I have not bought a single stock of a company that hasn't been a 7investing recommendation since I started. Why? Yes, I trust my thesis. I trust my ability to purchase stocks, but I trust you guys more. And you have timely company updates. If something changes in a company you recommend, we let advisors, we let our subscribers know, that I can focus on other things that are more important for my family and trust in you guys. So I'm grateful because it really has made a difference for my family.
Yeah, thanks very much for that,
I'd
Sam.
like to build on that a little bit, because I think there's a really interesting thing in what Sam said there as well. Because when you do have access to an army of experts who are really going deep, and we all do have our own areas of passion or areas of expertise. Even if you're not doing that deep due diligence, you're depending on other people. You can still use your own insight though, and you can still choose from that pre-selected universe of great companies and find the ones that really appeal to you, where maybe you're studying a particular topic and you know a little bit about where that industry is going, or perhaps an uncle or a family member or a friend works in the industry, and you can get a bit of a, not inside information, but you can get a bit of a sort of behind the scenes understanding. So you can still, even if you don't think you're an expert, I think you can still use your own judgment to make those selections.
Great point, Luke. And several of the things that you and Sam both just said, it kind of goes back to our mission of 7investing, which is to empower others, to empower you to invest in your future is our stated mission. That's different than a lot of other investing services out there, which might just be, hey, we're going to do it behind the scenes. Don't ask us questions. Don't worry about what we're doing. We're just going to talk about the numbers with you. That's kind of how a lot of this industry works. It's like, you're not supposed to ask questions, just have trust in the person that's managing your money. We're trying to change that. We're trying to make it where, we want to have a student call every month like this. We want to have a subscriber call every month like this. We want to have the conversation going on continually in our community forum where you can ask questions, you can chat with our advisors, you can say, hey, what about this rec that you made this month? What was it you really liked? Or have you seen this? Are you worried about that? I mean, I think that it's really what I get excited about every morning is that we are making a change out there. We've heard some awesome testimonials. Sam, I know that you've posted a lot of those now to our newly revamped website of kind of the change we're making out there with people. I really feel good about that. I love that. And so please ask us questions in the chat. I'm going to transition a little bit to talk about those recommendations we just mentioned. We're not going to reveal the names because this is a public facing live stream, but I do want to chat a little bit about kind of what we've discussed so far about what's going on in the market, kind of how we're hearing that inflation's going up and that interest rates are going to be bumped by the Fed this year. There's obviously an international conflict going on that's affecting a lot of things. Steve, I might start with you on this. Without revealing the name of the company you've recommended this month, I do want to point out it's a re-recommendation of yours. And it's one that you've been watching for quite some time. And you went back to the well again for another stake this month. What led you to your recommendation that you made this month?
Man, yeah, it's the third time I'm adding to the scorecard. Part of it's just that massive valuation contraction that I pointed to before. But another part of it it's funny because it was down a fair bit further just a few weeks ago, but it's still trading below its IPO price, which fantastic. I love the chance to add to my position at that time, but part of it was just misunderstandings for certain profitability metrics that I saw from a lot of investors out there that said, I'm done with this. They saw one metric climb up for one quarter, and management explained it, but nobody's listening. And so it's part of finding stocks that have been beaten down unjustifiably so for me often. And that's not to say, there's also some merit to adding to your winners as well. But this happens to be one case where I'm adding to a stock that is, in my view, has been kind of pounded down, and people I don't think should be criticizing it for the problems that it's had. So I think the market's come to its senses a little bit with the recent rebound, but still well below its highs. And again, not anchoring to those highs, but I think in another 5-10 years, this is going to be a company where people look back and kick themselves for not buying now.
And what do you mean, Steve, when you say valuation contraction? What does that mean, and why could that be important?
Right. So when we look at so take like there are no earnings in this case because we're talking about a yet to be profitable company, but one of the popular valuation multiples is people take price divided, the share price divided by earnings per share, right? So price to earnings, PE, and then there's also price to sales and enterprise value to sales. And you can look at those on a forward basis and trailing basis. And so there's all these different valuation multiples that you get. So say something's trading at 12 times sales. Valuation contraction is where you see that, and when you're looking at a chart, you see the valuation multiple fall. And a lot of times, it can be a function of maybe growth is slowing a bit. So the market isn't as willing to assign quite as high a valuation multiple to that stock because, growth isn't as high. Or maybe interest rates are rising, so they're doing some discounted cash flow model, and they're looking at okay, the value of its future earnings is less because the interest rates are higher. So it's all about the multiples, these valuation multiples. When I say that, it's we're talking about PEs, price to sales, enterprise value to revenue, something like that, coming down. And so that's actually something that for anyone who hasn't read, there's a book called 100 Baggers out there. You can probably spot it behind me somewhere here. And the author's, his name's Chris Mayer. He actually has a couple of really neat chapters on valuation multiples, and not necessarily this is how you value this stock, but how to think about valuation multiples. And one of the big drivers of share price returns over the long term is in time, the market being willing to assign a higher multiple to higher quality businesses. So there's lots written about it. But just one example anyway is one of those chapters called 100 Beggars. And while I'm at it, I'm going to dig up the old podcast that I had, because we talked.
I was going to say, you chatted with the author of that book, Steve. You put it on our 7 Investing podcast.
Yeah, it was fun. I had some video issues during that, so but the audio's fine. So for anyone who wants to listen to that, I'll put it in the chat. And he's a good guy to talk to. I tried to get him back on the podcast, but he said, "No, I'm taking a break for 2022. I'm not making appearances. So talk to me in another several months, and we'll see how I feel." But he's a good guy, and I actually happened to catch him. He responded to one of my tweets because I posted a picture of his book in front of a campfire. I was reading it while I was camping one day, and he said, "That looks great." Like, I was like, "Hey, come talk to me." He's like, "Okay." So yeah. I like how that kind of happens sometimes. God bless Twitter, right?
Steve is at 7investing Steve on Twitter. If you want to chat with Steve, or if you have a book that you're really proud about and you want an interview, please go ahead and reach out to him there too. But okay, so Steve, so if I heard you correctly, valuation contraction, if we're looking at PE multiples, price to earnings multiples, you're saying that sometimes companies are doing just fine on the earnings, right? Their fundamental earnings are looking just fine, but the stock price falls.
Yeah.
So the PE ratio might be decreasing just because people are, in a risk off mode, or they're selling off the stock, even though there might not be anything fundamentally wrong with the business.
Right. And, that's assuming it has right? Earnings. So in some cases, you kind of revert to price to sales, and sometimes it's price to book, but it all depends on the company. And that's an entirely different webinar, I think, is talking about, how you decide to value each company. But yes, sometimes those valuation multiples contract really hard, and we've seen a really, really, really steep valuation contraction. Multiples have come down a lot for high growth tech in particular, and small caps have really underperformed there. So that makes me kind of giddy. I'm like a kid in the candy store trying to figure out what to pick for you guys in these months. But I can't wait to look back, because in the same way as the market, I'm trying to figure out how to put this. In the same way as the market can get very, very overheated, like it arguably was at certain points last year, it can also get very, very overblown to the downside. So it's very mercurial, our market. And so what our job is to kind of figure out, when to kind of take advantage of especially where I think we are right now. We were really, really oversold even just several weeks ago. I think those, some of those prices for those businesses that have rebounded pretty hard in the last few weeks are now more fair. But I think for people who buy them and are holding them, and they're thinking in terms of a few years, I think these are the times when fortunes can be made, right? When you're taking advantage of these things, and you're buying them, adding to them, holding them. And one of the things, and we've talked about this too, it's actually in our frequently asked questions, like how to allocate your portfolio, or how do we buy? I don't generally put, like, if I want to buy a stock and I want to put about this much money into it, I don't buy it all at once. So we do recommend them kind of that way. So we say, I like the stock at this price. Sometimes you'll get a 20-30% decline, like you mentioned earlier, pretty quickly. And you're like, oh, I'm a terrible investor. I'm the worst at this. But, that's part of the reason I don't don't open the position at a full allocation all at once. So I might build on my position over the course of several months. In quarters or thirds of what I want to put into it. And that kind of helps, if it rises, at least you're partially participating in that climb. And if it falls, then you get the benefit of kind of dollar cost averaging your way down a little bit into a stock that you liked at a higher price. If it falls, you should be kind of celebrating that as a chance to add. So I don't get too hung up on near-term swings like that. If a stock 20, 30, even 40% sometimes going up and down, with my biggest winners looking back over the past better part of the 2 decades doing this, I look back and I think back, I've done charts, like hop over to Y charts and look at like the charts to see how far a stock has fallen from its highs at any given time. They have a neat little tool for that. And like looking back at Nvidia, for example, which I bought in 2009 first, and like the number of times it's fallen more than 20%, 30%, 50% is sort of staggering. And like each time you're so tempted to be like, oh, I'm done with this. But now you look back at those 20, 30, 40% declines that happened 10 years ago, and you can't even like spot them in the chart. But for the very best businesses, that's how long-term investing works. These are barely blips in the radar when you look at them years from now. And, it's no coincidence that people, when they look back, I'll stop talking in a minute, when they look back at their biggest investing mistakes, and they all involve selling something too soon. Yeah. So I try not to get too emotional when things don't go your way right away, because that's not how investing works.
Great reminder, Steve, of, distancing yourself from the stock chart. When stocks go down, everyone's reaction is, oh my gosh, it's falling, what's happening? You think of it as, hey, this is a great time to buy a great business. When everyone else is selling it off, you see something that the rest of the market might not be seeing. Bit of housekeeping, as we're kind of continuing on here, we are going to be publishing this live stream as a podcast. So thank you for everybody who is joining it live. We are going to be announcing at the end of the call a couple of free 7investing annual student memberships for those who are attending live. We're going to offer this every single month. Sam Bailey, our director of marketing, is here on the call with us. She's going to announce a couple of our live attendees to get this for free. If you are listening to the podcast, also a shout out, like Steve just said, to our partners, Y Charts. You can follow them on Twitter at YCharts. That is a great tool we've used. Everyone on our team uses this tool to kind of follow a lot of those fundamental metrics over time, see how stocks are performing. It's a great tool for valuation work like Steve was just chatting about. That's at YCharts. We also have a promotion that we'll be putting into our podcast as well. And if you are new to 7investing, this is the first time you've heard our podcast, on the first of the month, we always release our newest recommendations. We're chatting about a few of those right now. Steve just described what led him to his re-recommendation that is now a third time on the scorecard. We're going to be chatting with the other advisors as well about what led them to their picks as well. In fact, we're joined by Dana Abramovitz, another one of our lead advisors here at 7investing. Dana, we're just chatting broadly. Of course, this is a public-facing podcast and live stream, so we're not giving away any names just yet. But, we have our new recommendation just came out this morning. I know that you are a fan of the company that you picked. It was something that was new to me. What was it that kind of influenced your stock market recommendation here in April?
So it was really a lot of the trends in healthcare. So I, follow healthcare very broadly, and just pay attention to what's going on in the world, but always look at it through that lens of healthcare. And so, when I hear things in the news and, just like the economy and, the labor market, jobs numbers just came out. So when I hear about things like that, I always think about, okay, well, how does that affect healthcare? And then what healthcare companies are, involved in that and can be influenced by that somehow. And so that, that broader thinking is what helps me identify companies and form my investment thesis.
Dana, we were chatting just a minute ago about kind of what's going on with the economy, right? We're talking about inflation rates, soaring, and interest rates going up, and a lot of these things that are related to the economy. Do you think that healthcare is kind of insulated from a lot of that? I mean, so much of healthcare is based on clinical trials and hospitals and serving sick patients. That might not be as correlated to a lot of the rest of the economy. But how do you think about investing in healthcare? Do you worry about that stuff?
So yes and no. So the thing with healthcare is that we're always going to need it, right? So, whereas, like a luxury item or something like that, as with inflation or, changes in the economy, people can kind of, not purchase, extraneous things. But healthcare is something that we always have. That said, it is actually influenced, by the economy. People made, so healthcare prices rise. A lot of times, employers are paying for those healthcare costs. For your insurance, those benefits that you get. In many cases, that'll come back to individuals, in terms of like the dividends and what they're paying into their insurance. And so it may influence, whether or not somebody's going to get a treatment or delay a treatment that may not necessarily be, higher, healthcare related, like a life-threatening is what I'm trying to say. So, they might be able to put things off possibly, or not, depending on the economy, on the type of year, the time of year, that type of thing. So, there are all sorts of outside factors that do influence healthcare. But that said, for the most part, if you're having a heart attack or something like that, and you have to, go to the hospital, that happens. If you're going to have your knee replaced, on the other hand, maybe you can put it off for a couple of months or something like that. So, that's my thoughts on how healthcare, in the changing economy, anyways.
Yeah, thanks very much, Dana. Let's stick with healthcare. Let's stick with life sciences, because Luke Hallard, you actually picked a life sciences company this month as well. Tell us, this is a little bit out of my own personal comfort zone. This is something I didn't know a whole lot about before you picked it, but tell me what led you to your recommendation this month.
Yeah, I was a bit scared in stepping into the arena with Max and Dana because these guys are super smart and extremely experienced in this world. And I'll admit, I cheated a little bit, Simon. So Dana kindly gave me an hour of her time during my sort of primary research just to help me validate I wasn't going down a bad alleyway. I think I found a very, very interesting investment opportunity in the healthcare space. Um, it's a company that I personally invested in. I think about 2 or 3 years ago, 2019, and I've been looking for an opportunity to add to that. So, having made my 7investing recommendation, I'll be adding to that tomorrow. I think the thing that really, okay, I'm going to say one thing, right? So, the thing that is fantastic about investing in healthcare is you're not just, it's like ethical investment squared, right? You're not just buying something to make money and to improve your own wealth. You're actually supporting the mission of companies that are directly helping, people who have different health conditions. So that makes me feel really good about investing in companies like this. And so I'm kind of jealous of Dana and Max having this focus because all of their investments have this attribute. But I'm lucky. Oh, I feel so lucky to jump into the bathtub with them for April at least. But the particular thing about this company, without giving away too much information, that really attracted me to it is I'll explain the term, the razor and blades business model. And this company has a really, really powerful razor and blades model. And so what we mean by that, let's say sort of printers and ink, right? Because everyone, if you've ever owned a printer, especially if you've owned an inkjet printer, my God, they devour ink, right? You buy the printer, you're probably buying the printer from the manufacturer at cost price, maybe even they're making a loss selling you the printer because they know they're going to have you over a barrel on the ink for years and years to come. And so my health tech investment, it is very much in that realm. And in fact, to the point where, so they have a medical device and then they have accessories that you use when you use the device. And those accessories are disposables. So every time you have a procedure, you have to buy new accessories to do the next procedure. The company, they actually loan out the machine. They make such a tiny fraction of revenue from selling the device itself. In most cases, they just give it away to hospitals and to centers that need this product because they're making more than 99% of their revenue from the disposables. And it makes me think a little bit, I don't want to go too much down a rabbit hole about software as a service, but it makes me think a little bit about that kind of business model where, Steve is a real exponent of software as a service businesses because they are fantastic businesses because you've got this highly recurring revenue. You're sort of almost leasing the software on a month to month basis. And, it's such a reliable revenue generator because, next month your customers have to buy that product again. They can't unplug it. And so, my health tech company isn't a software as a service company, but I think in some ways they have the same attributes because they have that incredibly high recurring revenues. And at the same time, they're growing at an incredible rate. So those recurring revenues are, increasing and increasing year on year.
There are so many parts of that I love so much, Luke. The first part I think that I like is that, like you mentioned, that Dana just mentioned too, healthcare is here to stay. It's going to be around next month and next year and the year after that. But you've also built a recurring revenue stream out of it, just like, mentioned Steve, software as a service, SaaS revenue. I mean, that's kind of combining elements of different types of investing that you like into a single company, which makes this so powerful. But the other part I really like was that you mentioned chatting with Dana for an hour, Steve's previous experience that he has in SaaS companies. I mean, that's kind of something that I also like, which is that this team has access to different perspectives. We've got diverse backgrounds, which is pretty awesome. But you can chat about that and find it in investing ideas. And not only for your pick, Luke, which you did a fantastic job of wrapping that up, of kind of describing how it went into your process, but every month we have a subscriber call, right? Sam, we have a subscriber call coming up on the 15th of April, which is going to be a Friday. We always do it in the middle of the month on Friday. We can chat with our team about these kind of things and say, hey, did you think about this? You can even talk about stocks that are outside of our wheelhouse or outside of our recommendations. Again, it kind of all goes back to our mission of trying to empower others. I love that part of 7investing. Thanks very much, Luke. I'm really excited about your pick this month. Also, some other companies that are interested in your company out there too. I've seen it kind of been in the rumor mill of an acquisition, which is always good news when you see that happen. I want to chat.
Is it?
Go ahead, Luke.
I wonder. Can I challenge that though? Is it always good
please.
news?
Yes, go ahead.
Ah.
Please. Okay.
And I'm going to reflect back on where we started the call today, and we talked about being a long-term investor. So actually, although I would get maybe a minor bump on my stock price if my company was acquired, maybe I'd get 20, 30%, maybe I'd even get a 50% bump because they were acquired. I'm not looking for a 50% bump as a long-term investor. I'm looking for a 10x, a 100x return. And so actually, acquisition, okay, nice short-term benefit, but that would be a horrible outcome for my stock if it got acquired, honestly.
That's a great point, Luke. I should probably clarify my statement that it's good news when you have companies that want to acquire the company you're recommending. Maybe not necessarily if they actually do take it off the scorecard and take away those long-term gains. Great point. I can think of one of my largest holdings that's been approached multiple times for acquisition offers, said no every time, continue to go on and provide several multi-bagger returns. The company that I'm recommending this month is a financial services company. It's it's funny because when I described it to the team, one of our advisors, who actually is here on the team in the call right now, described it as competing in the 7th circle of hell, which kind of tells you how hated this industry is. This is something that needs to be fixed. It's a problem that is plaguing people. They hate it. This is the 7th circle of terrible torture that this industry is competing in right now. And I love that. Believe it or not, I love that. It means there needs to be something fixed. There's something that has to change. The consumers are crying for something to be fixed out there. And this is a company that's using technology to change financial services. The direct problems it is fixing are built upon, or the existing legacy systems are built on things that were built back in the late 50s and the 60s. They've changed in the 60 years since then, but they haven't meaningfully changed enough, at least for customer satisfaction perspective. And when we look at things like Net Promoter Score, the companies that are competing in this industry today, these are terrible scores. They are customers saying, hey, we've got to do something differently. And that's what led me to this company. It was something that I've been following for years, before even 7investing started as a company. Before I even started making recommendations for 7investing, I chatted in person with the founder of this company at a financial conference, and were just so impressed with what they were doing and how they were thinking about these problems and how they could fix these problems. And I've been patient because it just wasn't the right time to recommend it until now, and until we've got kind of these bigger concerns that America is facing, specifically related to interest rates, specifically related to inflation. There's a lot of challenges that America is facing, and it's taking a lot of the attention off of these types of companies because there's risks, there's uncertainties that are present. And I think that for me right now, this was the right time to invest in the right company with the right leader that was fixing the 7th circle of hell that was financial services beforehand. So I'm pretty excited about my recommendation this month. Again, if you want to look at all of our recommendations, 7investing.com/recommendations. You can filter them based on the type of investing you want to be. If you want to go after high risk companies or very high risk, you can filter for those companies. If you wanted to look for low risk or moderate risk companies, and even ones that pay a dividend, you can do that as well. It's on our 7investing.com/recommendations page. And so I think that, we're wrapping this up. I appreciate everybody who stuck with us here for the live stream event. Sam, maybe this is the most rewarding part of sticking around, is that we're going to give away a couple of free memberships here. We've promised 2. This is kind of from the generosity of some of the operations team that we have. That has said, hey, every month I would actually, one of our operations team staff has said, I really like the impact that 7invest is making. I'm going to forego the $84 a year that it costs for an annual student subscription. You can take that out of my paycheck so that I can sponsor one of the students on this call every month. And we were just so touched by that. We thought that was awesome, that we're going to match it also from the 7investing side. So we're going to give away 2 student memberships. And in fact, Sam, I'm feeling extra generous today. Maybe it's because it's April Fool's Day. I don't know why. I would actually like to give 3 free student subscriptions for the next year to people who are attending live. So let's kind of randomly select some people from the picks. You have to be live to attend, but could you pick out 3 student members that are going to get a free year of 7 investing here?
Sure thing. So Autumn, David, and Sergine, I'm sorry if I mispronounced that. You are the 3 winners. So thank you, Simon, for adding additional one. But I will reach out to you guys via email and we will get your membership set up. But thank you everyone for joining us. We really appreciate it.
Yeah, thank you. Thank you for attending. This is something that's a lot of fun for us. You can see you've got buy-in from our team to make a difference, make an impact. I mean, this is something that Sam and Luke and Steve and Dana, we feel pretty energized about doing these every month. This is kind of why we're doing what we're doing. We really appreciate your time. These will be on the first Friday of the month, every single month. We'll do another one in May. Thank you for sticking around. Congratulations to Autumn, to David, and Sergine for winning a free annual student membership to 7 Investing. We'll have Sam follow up with you about those here very, very soon. Thank you to my fellow lead advisors, Luke Hallard, Steve Simonton, Dana Abramovitz, and also the rest of our advisor team. We are excited to share our 7 investing recommendations for April. So please go check those out this morning. And we hope that everybody has a great weekend. We hope everybody has a great April. We'll talk to you again in a month on our next 7 investing student office hours. Have a great week. Take care.